In a volatile market, it's hard to know the value of a company. Professor Anat Sundaram has developed an app that makes it easy to know a company's value.
This app, by the way, it's called UValue, will do is, given what the market's assessments are about certain fundamentals, such as risk-free rates or bond yields and market risk premia, or the company's own judgments and forecasts about its cash flows and so forth, or long-run growth rates in the industry, you put all that in, what you get is an intrinsic value for the business from the standpoint of a long-run investor. And when I say long run, I mean at least a 3 to 5 year horizon and longer.
Warren Buffett, he's a famous value investor. He looks for companies that have a lot of value, but the price is really cheap, and he thinks the market will come up to that value. Does this type of app help people identify those types of situations?
It is exactly for that type of an investor. Because one of the big issues we always deal with, of course, we'd all like to believe that markets are very efficient. In other words, prices constantly, fully, immediately, fairly reflect all the available information. But evidence does show that sometimes prices take time to adjust to true values. Or sometimes they can overshoot the true values as well, not just undershoot. So, for instance, right now we're observing a situation in markets where one could reasonably conclude that prices are undershooting relative to intrinsic values. So if you truly believe that the fundamentals are what they are, and that within a reasonable band of error, look, the value can't be lower than X, but I'm looking at this market that is trading at, let's say, half X, just to take an extreme view, I've got to then buy and hold and wait to make sure that the market ultimately catches up to what one thinks that underlying fundamental value is.
You could also apply that to the other side of the market. If it gets too frothy and the intrinsic value is lower than this very high price, that it may be telling you perhaps it's time to sell that stock because it's getting too overvalued.
Absolutely. I mean, without a doubt. I mean, and you see this, you saw that with the example of the dot-coms in the late 90s, then with telecoms in the early 1990s, and then, in early 2000s. And then the networking companies, and some people believe that even with the recent IPOs, some of these social networking companies that are going public, or the Groupons, again, I mean, I'm not saying Groupon is specifically undervalued or overvalued, but people do wonder whether there's that frothiness that justifies a reversion to perhaps a more reasonable, lower price in the long run. Absolutely, that's what the model will, or UValue will help you do as well.